month of May is almost over. We're halfway through the year now, officially to 2021. Time flies. But here I'm going to give you 5 key points that I've written on my personal notes, sharing with you guys of what I should be watching out for, expecting, and be aware for going forward. 5 key facts point that you need to be aware, because sometimes there's a lot of noise in the market and we have to make our own approach and our research to go to it. So the first one I want to share is really the market is still confused. Okay, think about it. A minute where we say all rotating into oil, rotating into recovery stocks, and then they're stagnant, and now the growth stocks are back, and then cryptocurrency is down, and what's going to happen next? Nobody knows. It's going to go up and down. So what do? Things at times like this, investing is a long term. I take a step back. I don't have to swing my bet. I don't have to do anything. Sometimes not doing anything is the best, because the month of May, I've literally done nothing to my portfolio. I've seen it go down and then back up again. So what could I have done? Sell it off and try to time it for the bottom and expect the end of the month to be high? I don't know. That's where we are. So on the VIX going below 70.220 just now, about 16. So we're thinking it's not a time to buy. If there's profits that you want to take, if there are stocks that you want to cut loose, this is the time. We should have another week or so for it to stay that way. This is the time. But if you want to buy stocks, it's not the time, because they're all peaking just now. Wait for the right opportunity. Sometimes we don't have the necessary swing. And remember, the risk and reward value. So it's better to buy when the VIX is high, above 24, heading 30. So now it's starting to decline. So it's starting to just sit and watch and do nothing. Okay, next one is good growth versus bad growth stocks. You just have to watch out. Growth stocks are great, rotating is great, but good growths are the one that's got great earnings. They've got great forecast, 35 to 50% to 60% growth. They're making revenue. They've got a good roadmap. The likes example that I speak about every time is AMD, Nvidia, Coinbase, great. SEA Limited, another great company, and Lemonade, no revenue but growing customer base. Future growth, long term, you have to see long vision but high multiple. So those are the good growth stocks that you can see. But the bad growth stocks are the one that multiples. TTM, you can go Yahoo Finance, you can go lots of resource, the TTM, 12 months trailing, forward trailing. If they are over multiples of 30 to 40, you have to watch out. Okay, any companies with 30 to 40, they need at least a good 4, 5, 6 quarters of great earnings consistently to push it down. Okay, so you just have to watch for the high growth stocks, high growth multiples. So I know you're thinking like Alex, what examples are you talking about here? I'm talking about the space stocks, the Crispia. They're all rocketing up, but there's no sales revenue just because there's a news that's talking about them, and they shouldn't be rocketing up. We still have to base on the fundamentals. For me, I'm still watching the fundamentals. It's all about cash flow. If it's a good growth stocks with great cash flow, not making money, but great cash flow coming in, high revenue, fine. But if it's a bad growth stock that's just telling us tales, but you don't see money coming, they're still at a huge loss and going deeper, there's something to monitor. Okay, next one is oil rebound. Is it fake or real? Okay, we talk about this oil rebound. Oil going to 100. Some folks wrote about oil going to 120. All I want to tell you, I work in oil. Okay, it has not changed. I've not seen projects changing. I don't see hiring on the rise. I've seen it on LinkedIn, but I've not seen people come back to work. My neighbors all around me who works in oil drilling rig, oil platform, they're still not in a job. They're all working other jobs now. Okay, so it's going to catch up to a point where the companies where all hit the point where they're all starting to open up, starting to open projects, starting to open more campaigns, but they're not there to meet the demand. They can't get the skilled workers back in. And guess what? Expenditure will rise, because they have to pay these people to make sure they guarantee them a job for longevity and not sack them again if things go wrong. So if that happens, expenses go up. Despite how high the oil comes up, the profit margin is going to start reducing. So think about it. I'll be cautious investing in oil. It looks great. It looks nice. Are you in for the dividend? Are you in for the long term? Something you have to do in your head. Okay, next one. Value stock. Are they peaking? Okay, well, since stocks, recovery stocks like the likes of Disney, the likes of Boeing, opening stocks, steel manufacturing, timber, housing, they all come to a point, it looks like they're peaking. Even investors have stopped investing because it comes to a point where they're bubbling. Remember, value stocks peak really, really easily. Their PE and their price earnings are very easily. So once they bloat above 40, 50, 60%, they are maxed out. But growth stocks, on the other hand, they've got revenue. They can go 2x, 3x, 4x, 10x because they've got future valuation to come in. So be aware on the value stocks investing, and even fund managers are coming to a stop where I think they're valuing, they're bubbling. So it comes to a point where maybe we just sit and watch out. But the last one, for the fifth one, no stopping investors, the best performing fund index stock. Do you know who they are? are the index. Index are performing exceptionally well. The S&P 500, the FTSE, the Dow Jones Index, all the regular low-cost index are the ones that are doing well. All double digits, they're all above 10%. A lot of people's portfolio are either break-even or they're down from January. They're down maybe 5, 10, 15, 20%. But the index from January 1st is actually up 10, 11, 12, 15%. Even the German index is up, the DAX itself is up. Everyone is up double figures. So for you, if you're investing, it's no harm going index investing, because end of the day, we're still in a bull market. We're recovering. Okay, you might be confused, growth, oil, or should I go car manufacturing or Tesla type stocks? Then if you have, just put an index, because we're still recovering. When opening trade comes out, the government will be spending money, inflation will be high, but business will still need to go on, because we're coming out of a post-pandemic where we're actually not poorer than 2019. We actually got cash because of loads of stimulus check, loads of government support, and this is where we are. So index investing is not dead. It's actually doing quite well, and who knows, it might go even better for those who wants to just passively invest and ignore all the noise. So this is me. My 6 minutes is up. I hope you enjoy this video. Leave a comment below, and I hope to see you next time. Thank you. Bye.
I hope you enjoyed that video. Please like this video and subscribe to the channel. Please press the bell button. Ding dong. Finally, watch the recent video up here.